In 2007, Morgan Stanley was right that housing was cracking, and they still lost about $9 billion. The damage didn't come from the first mortgage bet. It came from the protection they layered on top. That protection was a hedge, a second trade meant to offset the first. What's interesting, when your safety move grows bigger than the danger, it stops protecting you. It becomes the real risk. And once you see how that happens, you start spotting it everywhere. Your umbrella snaps sideways the second the wind hits it. You wanted to stay dry for the 10-minute walk from the train. Now you're using both hands to stop it dragging you into a puddle. That's the shape of this mistake. The first problem was small, rain, annoying but manageable. Then the protection got bulky and awkward, harder to control than the weather itself. You see this with insurance too. Say your phone is worth $400. You add a protection plan, then a second add-on, then rush shipping for repairs, then a loaner device fee. At some point, you're not protecting the phone. You're paying more than the phone was worth. A bad hedge works like that. A hedge is a second trade meant to protect your first one. It starts as cover. Then it grows. Maybe it's larger than the first bet. Maybe it only works in one narrow situation. Maybe it brings a whole new problem of its own. Now the protection isn't canceling risk. It's reshaping it into something you understand less. The pattern is clear. Beginners miss this part. Two trades pointing in opposite directions doesn't buy you safety. If one side is bigger, more fragile, or slower to react, the pair can be more dangerous than the original idea. In plain English, you were worried about getting wet. Now you're carrying a 6-foot sail in a storm. And that matters because your brain relaxes the moment it hears the word hedge. You stop asking hard questions. You assume the seatbelt is on, so you drive faster. The reframe is simple. Never judge the protection by its label. Judge the combined mess it creates. If this helps, subscribe. 2 plain English breakdowns like this each week. So when you put the original bet and the supposed protection side by side, what should you check first to see the real danger? Start with a notepad, not the label. On the left, write your original position, a trade you already hold. On the right, write the hedge, a second trade meant to cancel out the first. Now ask 3 boring questions before you call the pair safe. First, what exact thing makes the first side lose? Don't say the market. Be specific. Rising interest rates, falling house prices, a bad earnings report. If you can't name the trigger in one sentence, you're already guessing. Second, what exact thing makes the protection side win? This is where people get sloppy. It goes up when the other goes down, sounds nice, but it means nothing. A seatbelt helps in a crash. It does not help in a flood. Your protection has to match the actual accident. Third, if both are wrong at once, which side is bigger? That's your exposure. How much of your account is at risk on a trade? If the so-called protection is twice the size, your safe setup can lose more from the hedge than from the original idea. Make it concrete. At 10:14 a.m., your phone buzzes. Bad housing news hits. The first side drops, just like you feared. But the protection side drops harder. It counted on a calmer market than the one you got. You didn't remove risk, you rearranged it. That's the trap. You can hold 2 trades and still face one danger. And once you see how the safe side quietly grows larger, the next question gets uncomfortable. Why can the side meant to protect you end up hurting more? Consider this scenario. You run a little ice cream stand on a beach boardwalk. Sunny Saturdays are great, rainy ones are terrible. So you open a second booth that sells umbrellas. At first, it feels clever. If the sun is out, the ice cream stand wins. If clouds roll in, the umbrella booth should make up the difference. 2 opposite businesses, one should cover the other. Then 2:17 p.m. hits. Your phone buzzes with a storm warning. Not drizzle, wind, hard rain. The boardwalk empties in 10 minutes. Now both booths are in trouble. Ice cream sales stop first, but umbrella sales do not explode. Nobody stays outside long enough to shop, and the umbrella booth costs more to run. Higher rent, more inventory, more staff. That is what traders call a hedge, a second bet meant to offset the first. A real hedge reduces your exposure, how much of your account is at risk on a trade. A bad hedge only looks opposite on paper. Under stress, both sides still depend on the same hidden thing. In that boardwalk story, the hidden thing is foot traffic. Sun and rain look like opposites, but both booths still need people walking past. Remove the people, and both bets sag at once. Now add one more twist. Say the ice cream stand can lose $100 on a bad day, but the umbrella booth can lose $300. The safe side is now bigger than the original problem. You didn't protect yourself. You promoted the backup into the main danger. That is why direction alone can fool you. This side wins if the other side loses sounds safe, but size matters, cost matters, stress matters, and the moment when protection should help is exactly when weak protection gets exposed. You see this in trading all the time. Someone holds one bet, then adds a second bet that seems opposite. Different label, different chart, same pressure underneath. When the market gets ugly, the small shield turns into an oversized weight. So the real question is not, do I have a hedge? It is, what am I still depending on, and which side gets bigger when things go bad? Because on Morgan Stanley's desk, that second side did get bigger. And that is where the loss stopped looking like protection and started looking like $9 billion. It's the same edge a poker player has at the table. The discipline to fold a tempting hand when the numbers turn, and the nerve not to tilt after one bad beat. It's hedged. That sentence can lose billions. Picture yourself on a mortgage desk. In 2007, a mortgage is a home loan. Housing is cracking. Headlines are ugly. The danger seems clear. Lower quality home loans keep getting worse, and the bonds tied to them keep losing value. Howie Hubler's team at Morgan Stanley made a call that was partly right. They believed some mortgage risk would blow up, so they set up two positions, the trades you currently hold. One side was supposed to benefit if weaker mortgage bonds cracked first. The other side leaned the other way on supposedly safer mortgage debt. On paper, that can sound smart. If one side hurts, the other side should help. That's what people mean by a hedge, a second bet meant to offset the first. But the catch was brutal. The safe side was still tied to housing. As the crisis spread, that side mattered more. Here's the everyday version. You worry your apartment might flood, so you get insurance. Then to save money, you also promise to cover your neighbor's flood damage. You think their unit is safer than yours. If a tiny leak hits your place, maybe the math works. If the whole building gets soaked, your protection does not protect you. It piles onto the bill. That's basically what happened. Hubler's desk was not simply protected against mortgage pain. It still had huge exposure. How much of your account is at risk on a trade? To the same housing system breaking all at once. And when that system broke, the safer-looking side did not stay safe enough. Correlations jumped. Prices on mortgage-linked products moved together. The offset was weaker than expected. The side needing protection was enormous. By December 2007, Morgan Stanley reported a $9.4 billion write-down tied to subprime and mortgage-related positions. A huge chunk of that was linked to Hubler's trade. He left the firm that year. The loss became one of the best-known blow-ups of the credit crisis. Notice the trap. The team was not crazy for wanting protection, and the stake was treating related as offsetting. If both sides depend on the same storm staying contained, you don't have true protection. You have two paths into the same fire. This matters to you even if your account is nowhere near Wall Street size. You take a position because it feels balanced. Maybe one ETF on one side, one stock on the other. Maybe a crypto trade and a tech trade. Maybe a safe add-on that seems like insurance. At 11:18 a.m., your broker app shows one green number and one red number. You feel covered, but if both positions still depend on the same thing not getting ugly, your net risk is hiding in plain sight. Your thesis, your specific reason for taking the trade, might be, these cancel out. Yet in stress, one side can suddenly dominate. A hedge that grows bigger stops being protection. It becomes the real bet. So, before you trust any offsetting trade, what 3 questions would have exposed this problem before the loss ever hit the screen? The word hedged can make you less safe. You take one trade, then you add a second trade meant to protect it. A hedge should make the whole thing smaller, but if the total danger gets bigger, you did not reduce risk. You hit it. So use a rule. Call in the Hedge Pre-mortem. If this is useful, subscribe. More like this twice a week. Before you enter that second trade, answer 3 questions out loud. First, what exact loss is this supposed to cover? Not bad stuff. Name it. A drop in mortgages, a jump in loan rates, one side of your thesis breaking. Second, what happens in stress? At 9:31 on a messy Tuesday, can both trades lose together? If the answer is yes, that second trade is not protection. It is company. Third, which side can become bigger? Not in your spreadsheet, in the real world. If price swings get wilder, if the market opens far from your expected price, if the safe side expands faster than the original bet, that hedge is now the main danger. That is the Morgan Stanley lesson. The first idea can be fine. The backup plan can still sink you. And once you have those 3 answers, the next question is simple. What tiny habit makes you actually check them before every trade? So here's your tiny habit. Before any trade, write one line on paper. If my protection gets bigger than my main idea, I'm out. That sentence can save you from a mistake. The kind that looks safe right up until it isn't. Want more rules like that in plain English? Subscribe. Next breakdown, I'll show you the quiet account killer. Almost nobody notices it until the damage is done.